Warren Buffett is currently hoarding a staggering $325 billion in cash.
Which is just a wild number to wrap your head around.
Right. I mean, it's larger than the GDP of a lot of countries.
Yeah, totally.
And at the exact same time, you have these bleeding-edge AI models screaming that the semiconductor market is a flawless, undeniable 10 out of 10.
The contrast there is just, it's fascinating.
It really is. So, welcome to today's deep dive. I'm your host, and joined as always by our resident financial expert. And our mission for you today is to analyze this massive collision, right?
Exactly.
We're looking at what happens when the cold algorithmic data from AI market models like Grok and Danilfin goes head-to-head with the gut instincts, the battle-tested risk management of super investors.
You know, guys like Buffett, Ray Dalio, David Tepper.
Yeah, the billionaires. So we've got our hands on the daily stock brief for August 13, 2026. And the overall vibe right now is, I'd say, mixed to positive, right?
Yeah, mostly because of that milder-than-feared inflation print we just saw.
Right, but okay, let's unpack this. Because to follow the actual money, we have to start where the market heat is highest.
Which is technology.
Always tech. But looking at the sources, tech is clearly no longer this single monolith. We have to separate the AI infrastructure from everything else.
Oh, absolutely. That bifurcation is the defining trait of the market right now.
So break that down for us. What are the models saying?
Well, Danilfin's AI score is basically giving a perfect 10 out of 10 specifically to the AI semiconductor leaders.
So we're talking NVIDIA, Broadcom, TSMC.
Exactly. The top performing ETF flow is SMH, the Semiconductors Fund. And the billionaires are validating this.
Yeah, the brief shows David Tepper is aggressively doubling down here.
He really is. He's adding 15% to his NVIDIA position.
Wow.
Plus a 12% bump to Meta and 8% to Broadcom.
Well, he's actually trimming his Amazon and Google, right?
Right. Because his thesis is that AI infrastructure spending remains robust. He sees that CapEx as a guaranteed floor.
I always hear people use this analogy, but it's exactly like the 1849 gold rush.
Oh, for sure.
You know, the people getting rich right now aren't necessarily the prospectors. It's the people selling the pickaxes and the shovels.
The semiconductor designers and foundries.
Right. But here's my question. I need to push back on this a bit.
Sure.
If AI is so incredibly hot and the pickaxes are selling out, why is the broader technology sector flashing a 5-day performance of negative 1.3%?
Yeah, and a bearish selective signal on top of that.
Exactly. Why are they bearish if tech is booming?
Well, what's fascinating here is a risk factor the market calls AI CapEx digestion.
CapEx digestion, what does that mean exactly?
It means the market is worried about semiconductor order normalization. They're looking ahead to when this frantic initial build-out phase slows down.
Like once everyone has bought their initial servers, the orders drop off.
Exactly. So the models and billionaires like Ken Griffin, who's actively trading Meta, NVIDIA, Tesla, they are being highly selective.
They aren't just blindly buying the whole tech sector.
Not at all. The Danilfin model gives Meta and Google a 9 out of 10 because they have the unassailable balance sheets to handle those CapEx costs.
Without going broke.
Right. They have massive free cash flow modes.
Yeah.
If a mid-tier tech company tries to compete, the smart money is just cutting them loose.
Okay, so they're dodging the mid-tier tech, and here's where it gets really interesting.
Oh, yeah, the rotation.
Yes, because if top-tier tech is looking a little extended and the rest of tech is bearish, where does the smart money go to find a bargain?
They head straight for the bargain bin.
Right. They pivot from growth to value. And it's amazing to compare the AI screens to the human value hunters here.
It's a complete convergence, but from totally different angles.
So on the AI side, Grok's undervaluation screen flagged the Hong Kong Stock Exchange.
Specifically Chinese tech and property at multi-year lows.
Yeah, and Danilfin completely agrees. It's giving 8 out of 10 scores to Hong Kong value plays.
Like Alibaba Health, ticker 9988, HK, and Tencent. And we're seeing the KWLB ETF rising on this.
So the AI is looking overseas for depressed multiples, but meanwhile in the US, you have Seth Klarman.
A legendary human value investor.
Right. And he is backing up the truck on the financial sector.
He's adding 25% to Wells Fargo and 20% to Citigroup.
Which is wild. And Danilfin actually backs him up. It scored JP Morgan, Bank of America, and Goldman Sachs a solid 7 out of 10.
With the whole financial sector up 1.8% and flashing bullish.
I just find it amazing. You have a bleeding-edge AI model crunching raw math and a human value investing legend entirely on the same page about sniffing out value.
Yeah, they both see the floor.
But is this just about low PE ratios, or is there a bigger macroeconomic catalyst happening here?
If we connect this to the bigger picture, for the financials, it's really about them being rising rate beneficiaries.
Because of the yield curve.
Exactly. A steepening yield curve is pure profit for legacy banks.
Yeah.
And you can see Ray Dalio playing this too.
Right. He added 18% to his TLT position.
Locking in those treasury yields. So the AI spots the mathematical floor, the price-to-book ratio, but the human spots the macroeconomic tailwind that will actually push the price up.
Okay, so that's how they're making money right now. Growth in AI, value in Hong Kong and banks.
Yep.
But moving on to the next part of the brief. How do billionaires protect their money?
This is where the defensive macro hedges come in.
Yeah, the billionaire doom hedge. Because looking at these risk factors, they are clearly afraid of something.
The defensive posturing is arguably the most critical signal we have today.
Let's look at Dalio. He made a massive move into gold miners.
His largest single move of the quarter, actually.
He bumped up his GDX position by 22%, and he's adding ConocoPhillips.
Because his thesis is all about hedging against fiscal and monetary uncertainty.
And then there's Buffett, actively reducing Apple by 10%.
While adding to energy. He bought 5% more Occidental Petroleum, 3% more Chevron.
And sitting on that mind-boggling $325 billion in cash.
With the energy sector being the top performer right now, up 3.2% and bullish.
Okay, so what does this all mean?
Wait a minute.
Because, I mean, Buffett sitting on $325 billion, is he just being a grumpy old bear? Like, is he just missing out on the AI rally?
That's a fair question.
Or does he see a geopolitical storm coming that a 10 out of 10 AI algorithm just isn't designed to care about?
I'd argue it's absolutely the latter. It's about what we call the energy security premium.
Okay, break that down.
Buffett and Dalio, they aren't day trading momentum. They're looking at physical world risks.
The brief mentioned the Middle East escalation?
Exactly. Tensions in the Strait of Hormuz. If that choke point gets blocked, the brief projects oil pushing to the $85 to $95 range.
Or even 100 plus, which they say would cause a stagflation scare.
And stagflation is the ultimate nightmare. Plus, you have the risk of a Fed policy error or a China stimulus failure.
So they view energy and gold as critical inflation hedges against all of that.
Right. Dalio shifting away from tech ETFs into GDX. That is a classic textbook defense against central bank policy errors and exploding fiscal deficits.
So the AI says buy the math, and the billionaires say protect against the real world.
Precisely.
Okay, so let's bring all these high-level billionaire and AI concepts down to earth for you, the listener.
How to actually apply this.
Right, your personal playbook based on today's brief. What are the actionable takeaways here?
Well, synthesizing all the sources, the consensus is to be overweight in AI semiconductors.
Yep, the pickaxes.
Overweight in Hong Kong value and U.S. financials.
For that bargain hunting.
And overweight in gold miners and energy.
For the doom hedge.
Exactly. Now, on the flip side, you want to be underweight in consumer discretionary, which is flashing negative 1.1%, and bearish in communication services.
Wait, okay, hold on. There's a glaring contradiction in the data here.
With the consumer discretionary stuff.
Yeah. The brief explicitly says to underweight consumer discretionary because it's bearish. But Bill Ackman, who is basically a macro genius, just made a huge move there.
He did.
He added 18% to his Hilton Hotels position.
And he added Chipotle, too, ticker CHIP.
Right, while reducing restaurant brands. So why is Ackman deploying so much capital into a losing sector?
This raises an important question about how we define sectors.
Yeah.
Ackman isn't betting on the whole consumer space.
Oh, he's being surgical.
Highly surgical. He's betting exclusively on companies with fierce pricing power.
Okay, pricing power. Like Hilton.
Exactly. Think about Hilton. They don't own all those physical buildings, they franchise them. And they can change their room rates literally every single night to match inflation.
Oh, wow. So if costs go up, they just bump the room rate tomorrow.
Right. Whereas something like restaurant brands might struggle to pass those costs onto a lower-income consumer as quickly. Chipotle has that pricing power too, with a higher income demographic.
That makes total sense. So he's not buying the sector. He's buying inflation-proof margins.
You got it.
Okay, but for the everyday listener, probably the most vital takeaway here isn't just the stock picking.
No, it's the cash reserve.
The brief recommends maintaining a 15 to 20% cash reserve.
Sort of a Buffett-style dry powder strategy.
But 20% feels like a lot to just leave sitting there, right? Like, that cash isn't doing nothing, is it?
It's definitely not doing nothing. In a volatile macro environment, that cash is dry powder, ready to deploy when volatility hits.
Oh, like Ken Griffin shorting the VIX.
Exactly. You want to have the agility to step in when the market panics.
Okay, so to wrap this up, the winning strategy right now seems to be a real hybrid approach.
Taking the best of both worlds.
Right. You use the hyper-fast analytical power of the AI to find those 10 out of 10 tech stocks and the undervalued Hong Kong plays.
Because the math doesn't lie.
Right. But then you overlay that with the grounded, risk-averse wisdom of the...
All information provided is for educational purposes only. Always consult with a qualified financial advisor before making any investment decisions.
Thank you for watching. Please like.
All information provided is for educational purposes only. Always consult with a qualified financial advisor before making any investment decisions.
Thank you for watching. Please like and subscribe to our channel.